Well, welcome to another, or actually not another, a special edition for Market Rebellion. We've listened to you guys, and we really felt like we should answer some questions. We had questions like, hey, the market's been down now a little bit. Now this Monday was terrible. How do I hedge? How is it already too late? What do I use to hedge? What can I use? Do I use simple puts or spreads? Do I use index puts, or do I use, puts of the underlying equity I hold? How can I use the VIX? So we're here for you today, and I'm really happy to see my beloved brothers here, Pete Najarian and Bill Johnson, who are gonna enlighten you, and they're gonna obviously give you some information and share some insights with you. The way we want to run this today is very simple. Bill and Pete going to talk a little bit about, the current market situation, specifically how Pete's been trading is, how he's normally hedging. They will take some questions, and then Bill will go into more details on the educational side. We hope it will help you. We're here for you. This is a members only webinar. We're really excited to share some insights, and hopefully we can help you guys. I'm going to drop off. I leave the floor to Bill and Pete. Guys, have at it, and hopefully we can help our friends here and our members at Market Rebellion.
Awesome.
Definitely.
Yeah, for sure. Well, Bill, I'll let you kind of maybe take controls. You're kind of the professional of the two of us, for sure.
Oh yeah, for sure. Yeah. No, I thought maybe we could start off just doing some questions. I know Dirk said we could do a little back and forth, and then I could do an educational side. I do have some slides at the end which will answer a lot of the questions that Dirk talked about. But one that I wanted to bring up to you, we know that markets fluctuate all the time. You can't just hedge just because you have a pullback. It's part of it's a necessary evil. That's what gives us the rewards that we're after. But for you, whether now or back when you were doing the market making, is there a catalyst where you would say, this time is different, and I think we need to hedge versus this is just a little bit of a minor pullback? Is there something that you look for?
Yeah, it's a great question, Bill. I don't know that it's necessarily always easy, and I don't think it's always.
Not.
Yeah, and I don't know that I always feel like there's a real clear vision of that. But I would say that when there are a lot of interesting storylines that are feeding into the markets, and we're seeing the volumes that we see, and when I say volumes, I don't just mean sheer volume, and you know that, but I'm talking about volumes specifically. And are they buying in specific names? Are they going after indexes? Are they doing both? Are they going more for puts right now, and they've been all calls? All those kind of things come to mind, and I pay attention to all of that. And one of the things that I know you see as well as I do all the time, because we see so many great things in the marketplace because of a lot of the systems that we've built and everything else, but the flows that we see. I didn't think necessarily today was going to be an up 600 day. I really didn't see that coming. But at the same time, we're down on Friday, 300 points. We're down 725 points on Monday. But into those drops, you and I are seeing option flows that are very bullish. And, you scratch your head, you're like, what are these guys doing? What's happening here? And yet, we do live by what we see and what we are seeing transact in front of us, and then try to ride those coattails a little bit. And so it does help us, I think, sometimes navigating a lot of these markets. And, we see these flows. I used to stand on the trading floor, and, just as an easy example, but when every broker on the Chicago Board Options Exchange is standing in the back of my trading pit, and they all want to buy puts, you can bet that I'm feeling a little bit more bearish than I did 2 minutes before they walked in.
Right.
And the same is true under circumstances like we did see on Monday, because on Monday we're down close to 1,000 points on our lows. We actually kind of rallied a little bit, to finish only down 725 points. And they were hitting everything, whether it was energy or materials or financials or what. Everything was just taking a pretty good shot. But, so that was pretty broad. But the volumes that we were seeing, the volumes of buying that we were seeing still on the call side, really still dominated what we were seeing. So in other words, think of it this way: standing in the trading pit and all these brokers come in and the market's going down, 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 and yet they're buying calls. That's really unusual. So
Right.
this was unusual option activity that we were seeing. And, so I still trust the flows when I'm looking and I'm trying to find it, make sense of anything. And we didn't close on the lows of the VIX, which were, or highs of the VIX, but the lows of the VIX, which was 25, I think we got up to, Bill, yesterday. Still finished 22, but still we're in that 20s, in that zone of 20 to 25. And today it just felt like a day that once they started buying, they just continued to buy. And I know we didn't finish on the absolute highs, but there was a lot of strength again today. So there was strength coming in when we were down a lot, and there's strength coming in when we were rallying.
Right off the open. Yep. Yeah. I was talking to some traders about that, and I said, for me, it's going to be, because you do get these positive feedback loops where just people are just selling just because everybody else is. Why are you selling? I don't know, because everybody else is, and they just keep doing it. But I said, for me, it's going to be Tuesday. Tuesday is going to be the telltale sign. And then I saw we were up about 200 points before market open, and then, like you said, right when the bell rang, it was just off to the races.
Yep.
And then you get the positive feedback loops on the way up as well. So let's talk about that. Let's say that you do hit one of these catalysts, and for some reason it does trigger a bell that this time is different. All the JP Morgans are down there buying puts and saying, this might be different.
Yeah.
Would you typically take a put on an individual stock, because we know that we start getting the really high implied volatilities, or would you usually use spreads?
I'm almost always going to use the spreads. And
I do too.
And if you would have said, well, I like the individual, I'd say fine. Everybody's going to have their own quote unquote risk tolerance, or what they believe deemed to be the best way for their comfort level. But for me, and this is true at other times too, even on the upside, when I'm seeing some of these very expensive stocks where, you've got a stock that's trading at $300 or $400 or $500 a share, and you've got calls that are trading at $20 a call,
or more. Right.
It just makes, you still want to have enough of a position on to make do and make sense, but I'll spread those oftentimes too. And it has nothing to do with necessarily that I'm less positive on that trade. It's more about just trying to manage the money aspect of it a little bit. And with the puts to the downside, I don't do them all that terribly often, but I absolutely do them when I think it's appropriate. And I almost always will spread those. And I do it very frequently. I don't ever hardly trade the VIX. The way I trade the VIX is I use the spider. I use the SPY. Yep. And so I'll use a spider put, and I'll put on a spread to the downside if I think that I think the volatility is still going up, and I think there's got a lot of pressure on the market. It helps me sleep, at night, because you've got all these other positions on. You can almost balance out those positions to some degree, a pretty good degree, if you've found the right type of spreads to put on out there in the spiders. Yeah,
and I agree, and as you should. I think it's just another form of a hedge. But I'm glad you brought that up about the VIX, because as Dirk mentioned, I'm going to do a little educational section with just some slides and a little more of a presentation, and I'm going to be talking about the problems with the VIX. Yeah. But I know I've heard you talk about many times in the cocktail hour that you use it more as an indicator. Yeah. Maybe you get up above the 25, 30, but you got some kind of a benchmark. You'll start turning towards the selling. If it's below here, turn towards the buying. Yep. What are your views? I mean, I know what mine are and some I'm going to talk about, but why you have to be so careful about trading the VIX?
Yeah, the VIX, the problem for me originally with the VIX was, when they first brought out the VIX in terms of all the trading ability on it, they priced it in an interesting way. And that sometimes it's almost like these double and triple leverage type things where people have to really fully understand, what does that really mean? And when they're recategorizing almost everything on a nightly basis, that changes the dynamic of the moves that you're doing. So
yes, it does.
It can be a good trade, but that trade has to be so short term, almost hours rather than days, that it just doesn't work as well for me. So I just don't find myself all that often in these leveraged products or the VIX itself because of the pricing model that they decided to go with. It doesn't work the way people would think. And that's the easiest way for me to just sort of describe. If you understand options and you understand individual options on individual names, that's great. That's not what the VIX looks like. and so, and you'll do a much better job describing all of that than I would, but I would just say that people have to understand what you're trading, why are you using whatever tool it might be, and is there a better way? And for me, the better way with the VIX is the SPY. I don't know about you on this one, Bill. I really don't like trading ETFs. And my rationale there is I want to get the bang for my buck. And so, and I've talked about this on happy hour and cocktail hours as well, oftentimes, where if I'm trading something, I oftentimes really want to be very defined in what I want. So if I see, for instance, the XLF, and we see somebody buys 100,000 XLF out of the money calls, on a trade like that, I absolutely will right away go to JP Morgan or one of the highest level areas, depending on where things are at that moment. And I'll actually put on the same trade, but I'll use JP Morgan rather than the XLF. And
I see. Right.
In the XLE, I'll use Chevron or Exxon rather than the XLE.
You'll pick out one of the individual components out of there.
Right. Especially in a lot of those products in these ETFs where you do have an absolute difference in terms of, I believe in Chevron and Exxon's case, what are they? Maybe almost 30% of the XLE anyway.
Exactly. Right.
So they kind of are the XLE. And so
Correct.
I'd rather
Highly
get the
correlated.
bang for my buck out of a Chevron call spread. And oftentimes I already own Chevron, the stock. I'll just usually go right to Exxon and I'll put on a call on Exxon, or I'll put on a spread on Exxon, or I'll do something there rather than doing it on the XLE.
Yeah. And if the ETF is rallying, then to keep those in balance, they have to be buying those component parts.
Right.
So you know that's going to take the ride too as well.
Yep.
Yep. But I'm glad, it was interesting what you said about the VIX though, and I'm actually going to be talking about that. But I think a lot of times people don't realize the specifics of how it works. Mm-hmm. And then also with, even just the up down, it's more of an inverse index. People say, oh, I think it's going down, let me buy puts. And I'm like, no, you should be buying calls if you're bearish on it, because that's going to be spiking. But they're priced more to the futures contracts than to the actual index, because the index cannot be traded. And that's one of the things I'm going to be talking about. But I think it lends itself to telling traders that you have to be careful, because if you don't understand why you won on a trade, you're not going to understand, when it doesn't work. And like you said, it might turn out to be a good trade. And some of the times in the past, you might have had some good trades with a VIX.
Yeah.
But if you don't understand why, then you shouldn't count on it to work.
Yeah.
Whereas if you take the simpler strategies, like you said, I'm just going to pick out one of the members from the ETF and buy it. But you've got to have some methodology for it. And those are all the things that we like to, and our coaches like to teach.
And it's why I always bring you guys up at the end of the take every single day, 5 days a week. I will say, if you don't understand what I'm talking about when I mention theta, or when I mention some of the Greeks or whatever, some of the pricing, or why some things make more sense than others, it's because the people need to have the knowledge, and you guys do such a great job. And it's not just because you work with us here and you're part of Market. You guys are that good. I mean, you really are. You guys are so patient, and I brag about you all the time, because I think that people, and I hear it from people, when I go to a conference or something, I can't tell you how often somebody will stop me and go, God, that Bill Johnson's unbelievable. Or that student's unbelievable. Because you guys you're patient, and you're able to get people to understand concepts that sometimes might be a little difficult, but you can, and I hate the phrase dumb it down, but you can make it sound a little bit easier than it actually is the way I would say. And that's key. And that's something that I do. I've taught my children, I've taught my wife, I've taught many, many friends. The guys at my team of guys at Morgan Stanley know the options world backwards and forwards. And it's not because they were brokers. It's because they've talked to me and they know what you guys do. And they jump on calls once in a while here with us because they want to know a little bit more. But the educational side of this thing is key. And the worst thing that can happen is you have an ungodly success on your very first option trade, but you have no idea what you were doing, and it just worked.
Just to death.
Well,
now I'm gonna bet it all on trade too, right? Because I got it all figured out.
Yeah.
Yep, exactly. Another question with the if you do come up to a point where you say, okay, I definitely want to hedge, regardless of how we decide to hedge. I think the average bear market's usually about 9 months if you look at it historically. And of course, a lot of these are just very short-lived. I mean, even coronavirus, I was shocked that we came out of in 3 or 4 months.
We did, yeah.
What type of a time frame would you look at? I want to go buy some S&P puts because I need to hedge. And of course, there's other factors that we have to look at the theta. We have to look at the exposure to volatility, the vega.
Yeah.
What are some things, are you going to buy the 2-month put, the 4-month, the 6, or buy it for 6 and sell it in 4? What kind of a strategy would you use?
That is a great question, and I don't know that I have the simple answer, because I think every time that we see in the markets is a little bit different than the other. I mean, this pandemic was like nothing I'd ever seen before. So different than the financial crisis that we had, because the financial crisis, at least we could figure out, hey, this is what happened, and this is why things are the way they are.
Correct.
Pandemic, you have the pandemic itself, but then you have all the after effects of it, which includes stimulus, the Fed, all the decisions that are being made. I mean, there's so many aspects, and it's still going on, to be honest with you. I mean, we all see it. I go to restaurants here in Minnesota, and we opened up relatively earlier, not like Florida, but earlier than California and some of the East Coast and all the rest of it. But I'll tell you, restaurants in general are closing at 8 and 9 o'clock at night rather than being open till 10 or 11 at night, and even on weekends. And that's not true of everybody, but a lot of them. And a lot of that's by choice, because they don't have servers, they don't have cooks, they don't have and those are all the pieces of this puzzle that we're dealing with now still. And it's still going on. And now all of a sudden, which is why we were down 1,000 points, I think. Suddenly there was this dramatic focus just head on. The media really blew it up too on the Delta virus. And so, and I'm not saying anything against the media, but I'm just saying the media really just, every single news story was the Delta virus, and this is what's going on. And
variants.
Yeah. And you and I are well aware. We see it, we understand it and everything else, but there was such a focus that it really just hammered things Friday and Monday. And for whatever reason, we eased back really, really rapidly. The accelerator pedal suddenly was going in the other direction.
Well, that's what brings up another question, and that's, I think, the hardest thing about trying to hedge in some type of an abrupt change in the markets like this. I've always told traders that you really need to be right twice. It's a little bit like people say, I'm going to sell everything and I'll get back in at the right time. Well, in order for that strategy to work, you need to get out at the right time, but you also have to get in at the right time. And it's the same thing if you're out there buying a boatload of put options. Yeah, they might go deep in the money, but now do you sell them and find out that the market really capitulates and you're going, well, that didn't work out so hot? Or you're going, man, I'm glad I bought those puts, and then 3 weeks later they're out of the money and you lost it all. Yeah. What is there a time frame that, let's say, if you've purchased these puts, or are there certain things in the market where you say, I think this is time to unload them?
Mm-hmm. I think a lot of the time for me, when I'm looking at the puts and I'm looking for any kind of protection, first of all, I generally am looking a little more shorter term probably than most. And it's partially because I'm still a trader, but I have a lot of stock positions. I don't think people really fully understand, like, the fact that at any one time each week when we give our disclosures to the folks at CNBC or wherever, I've got about 30, 35, maybe 40 stock positions on. And then and many of them are years and years, whether it's Apple or Merck or Pfizer, or there's so many that are had for a long time. And I just believe in the companies and nothing's changed my mind. So I sell calls against it every single month or week or whatever the case may be.
Yeah, great.
And it was kind of like the Netflix trade you and I were talking about, but it's just, so I've got that, but then I've got the option side. And the option side for me, the stocks, unless there's something specific to those stocks, I probably am holding on to them. And I went through the pandemic holding on to the same stocks that I had. I didn't sell them. Because I didn't feel like there was reason to sell those stocks. I bought them for the reasons I did, and I knew that at some point we come out of the pandemic and then things get a little bit better.
Yeah.
But, yeah. So
if nothing fundamentally really changed with the company,
right.
it does become a hard thing to say I need to sell just because we're in a pullback. Yeah, I tell traders that all the time in the webinars. You have to understand this is what markets do.
Yeah.
And I know you and John and myself and AJ and everybody have been in the markets for a long time, and you realize this is nothing. I mean, coronavirus was something new, but just in terms of being a very abrupt, sudden, dramatic pullback, they're really nothing new.
Right.
And yet here we are at all-time highs. The markets always find a way, to come out of them. And I think that's probably the hardest part about hedging. You have to realize it's a very short-term window.
Mm-hmm.
And is it worth doing? And if you do it, how do you go about doing it?
Yeah. I think the other thing too, Bill, sometimes is that I don't think people absolutely always have to feel the need to be fully invested in the market. I mean,
Very true.
I think, and the reason I say that too is on a pullback, don't you want to be more like Warren Buffett, where you actually, and that's, sometimes it's what frustrates me when I'm on those shows that we're on, because oftentimes I hear people say they're fully invested, and then we go down and they said, well, I acquired more. And it's like, well, wait a minute. How did you do that? I mean, if you're fully invested, you're fully invested. So I think you always want to have, some sort of money outside of that, wherever that area might be of comfort.
Sure.
But you want to be Warren Buffett. You want to be able to be in a position to buy when there's blood in the streets, like we've seen in the financial crisis. He did that with Bank of America and all these other, stocks, and mostly in the financial world. But, same thing in the pandemic. There were opportunities on stocks that absolutely got clobbered. And we all know many of the names because they're the first ones to really rally back, because all of a sudden everybody got a little bit more comfortable and they felt a little bit better about things going out, and they understood that, hey, we're working on these vaccines. We'll get these vaccines. When we do get these companies should still survive pretty nicely. Those come back so fast that if you have the dry powder to buy those,
it's a better move.
And you don't buy the bottom, but you buy some of those, it's an opportunity. And we talk about it all the time. You do too. Opportunities are what we're looking for all the time.
That is exactly right. Exactly.
Hey guys, I'm going to jump in here. A couple more questions. I know Pete has to go. We got some really cool questions here. So one of them, and I think partially you already covered it, but it's this whole thing about hedging. When do I hedge? Do I constantly hedge and just roll over? And I think I already know the answer to that. But so the question is from Joe, do you want to place your hedges when the indexes start to pull back, or do you keep hedges in place all the time and maybe just keep rolling out week by week? How do you normally do this, Pete?
So I am relatively hedged, Dirk, a lot, but I'm not always quote unquote hedged. And what I mean by that is, like, for instance, great example would be just about every single stock that you see in my portfolio when you see what I own, whether it's Apple or Pfizer or whatever it might be. I'm trying to sell calls against those every single week if they have weeklies, or every month if there's monthlies, or whatever is the most appropriate. And so that's the form of hedge that I oftentimes am using. Once in a while, when things just don't feel right and we start seeing what Bill and I were talking about, the flows, the money flows, and if we see gigantic spider put buying or huge VIX buying that we still will talk about, but I'm not trading that VIX. So then, yeah, that's when I'll follow right with them, and I'll put on a spread in the spider just to have that on. And, it's amazing how often we can find ourselves in the right position with those kind of hedges, because we've seen these gigantic trades that come in. And I got to tell you, when I say gigantic, when we look at some of these index trades and VIX trades, they are monstrous. They're hundreds of thousands.
Oh yeah.
And the craziest, just on a side note, Dirk, one of the craziest trades I've seen in a little while was today, actually, when we had somebody buy 90,000 calls in Apple, just in a chunk. I mean, it wasn't like, Apple's traded 200,000 contracts today. this was 90,000 contracts in a chunk, basically, at the 145s when the stock was 145. You know, you don't see those kinds of things every day either. So that's what, you know, it makes some of the triggers for the unusual really stand out. But in the spider, once in a while, we'll see these kinds of put trades that you don't want to not keep track of those. You want to keep track of when you see somebody buy 200,000 puts or put spreads. I'll put that same trade on just because I'm going to have some of that protection to the downside, because I don't think anybody's out there trying to waste their money. I think these people are out there hedging different portfolios, and I'd like to be a part of that too.
So 90,000 would be what, 9 million underlying shares?
Yes, and I was just pulling it up now, Dirk. I'm just because I think it is interesting. So they were this week. The stock was trading at 145. They bought 90,000 of them for somewhere between $1 and $1.70. So not a bad. You know, those are the triggers. And I brought this up to Scott and those guys about a week or so ago, that we were seeing all of these, you know, Apple, Microsoft, Nvidia, you know, Netflix, all of these where they were just coming in and they had a great run. Apple in a fairly short time frame now has run up from call it $129 mid-June to where we are today. So you know, they've been right, and that's even just as important as anything else is.
Right.
When we follow some of these things, Dirk, and there are some names where they just are not right. And I stopped buying. I'll give you a great example. I stopped buying Rocket Mortgage, RKT. And the reason I did, we see the unusual hit constantly. But whoever those funds are, because they're large trades, they've been wrong. So, you know, like anything else, not everybody's always right. And I just won't trade that until I see them be right at some point in time. They will be right sometime, but they have not been very right at all in that specific. They've been right in Apple. They've been right in Microsoft. They've been right in Target and some of these other kinds of names, Walmart. But they have not been right in. There's definitely a handful of stocks where they could buy as many as they want, and I'm not going to follow them because they've been wrong for too long.
All right, we're going to take 2 more questions, and then Bill has to go on to the educational part, which we promised all the viewers. All right, so first one, and it's pretty much, it's along the lines of what we asked, but TT is asking, hello, can you guys please cover how you navigate buying options on stocks in a down day like yesterday when the VIX is very high? Obviously, it's lucrative to jump in on discounted stocks, but when VIX gets crushed, premiums next day get hit, even next day, even if next day we have a nice reversal. So basically, how do you handle a day like yesterday?
You don't buy in those days.
Yeah, or yeah, you're right. I don't disagree with Bill at all. But the other side of it too is, okay, so it's a down day, right? Implied volatility is coming up. You've got a VIX trading at 25, and they come in and they start buying, let's say, Merck. I spread it off. If I want to be in there, I'm spreading it off, because that way I'm getting burnt a little bit on the more expensive call that's maybe trading at the money. But I'm selling the out of the money call, and it's probably got an even higher implied volatility that I can kind of use against the other. So,
correct.
You know, we talk about spreads, and Bill knows them better than anybody. But I mean, we talk about these spreads all the time. I really don't do more than a 2-legged spread ever. I don't do butterflies, really. Not against it. I know we do it as a company, but I personally am doing call spreads, verticals, or put spreads. You know, that's what I'm doing. So it's just 2 legs. I'm not smart enough for all the other legs to go into the.
Okay, two more questions quickly, and then Bill, it's all yours.
Okay.
When you talk about Pete, when you talk about selling calls against your stock positions, what time frames and delta levels do you normally use for choosing to write your short calls?
It's a great question, and I can give a pretty easy answer. So I generally, I'll just use Target as a great example. Okay. So Target's a stock that I've owned for a long time now, and I've been selling calls against it. And I try to sell an out of the money call against it, a certain percentage above where the stock is at that time. You know, and everybody's going to have a little bit of a different risk reward, Dirk. So it made that part is a little bit more difficult, but I will say I have to get paid enough premium for it to make sense, or I won't do it. So I try to cover every single stock with a call. I don't always have every single stock covered with a call, but so I try to sell as short a term as I can. And this is something I know Bill will be able to go through tonight easily, but I try to sell like a 2-week out option, for instance, or maybe even a week out option, because that's where theta time really crushes against those options. So if I can sell those, if I can do a 2-week and I do it twice a week, or twice a month rather, and I got 50 cents on one and 50 cents on another, and I'm getting $1 a month for an option against a $50 stock or something like that. It's something we talk about all the time, but at the end of the month, if you're getting $1 a month, that's $12 on a $50 stock, and you probably are getting a 3 or 4% interest rate already on that stock. Boy, all of a sudden your return on a stock, if it does nothing, can be pretty amazing.
Can be good.
And limits a lot of the risks and everything.
All right, last question. Pete, as you process activity with an unusual option activity, are there specific attributes that constitute a high conviction trade for you, specifically in these volatile times?
Probably most importantly than anything is through experience, seeing which ones do work the most frequently. And I know that sounds crazy, but the reality is there are many stocks where the folks that are trading those, the funds that are trading those, just aren't right. And we were talking about Rocket Mortgage. There's a list of stocks that they just consistently are not right. But I feel very comfortable and confident when I see NVIDIA call buying, or I see Apple call buying, or Microsoft, and then there's a long list. I feel much more comfortable about that. AMD is kind of 50-50, to be honest with you. It's one of the most popular stocks. Everybody loves to talk about it. Boy, they're just doing everything right and everything. I mean, we hear it all the time, but that one's not as consistently right as others are, in that same sort of semiconductor space. So, I think over time and getting a little experience and watching what's going on in the unusual options activity that's in front of us each and every day, I think that is very, very helpful, which is another reason why you don't just got to jump in. Some of the biggest mistakes people make, Dirk, in my opinion, are that they jump in too fast without enough knowledge, and they try to trade too big right away, because everybody wants to buy, just as an example, 100 calls in this stock. Well, that's great unless it doesn't work. And now you're frustrated and you gave up a decent amount of your capital that you had to trade. There's nothing wrong with buying 2 options, 5 options, 10 options. It doesn't matter. It's all ego. It doesn't matter until you get more comfortable and you understand things. And like the last thing I'll say is, you never want to be that person who has the blinders on because they have one trade and too much money in one trade and they can't see anything else in front of them. And that happens to the best of them. I know a couple of guys from CNBC that actually were asking me questions today about certain options that they can't take their eyes off of. And I said, why did you trade it so big? Why?
Yep.
What were you thinking?
The risk is managing them.
Yeah.
Hey, so guys, I just shared the link. So we have a course called How to Create a Crash-Proof Portfolio. And so Bill later on will share the link as well and show you guys. I just shared the screen as well. So if you guys really interested, it's free. It's just for you guys, for your educational purposes. I want to thank Pete for his time.
Yeah.
And now we're going on to the education guru.
He's the best.
I'm excited about that. Exactly the best. Bill will run you through, a number of scenarios and questions you guys have. And I think I'm very excited. I'm going to just be in the background listening to it. But Bill, it's all yours. Thanks, Pete.
Yep.
And again,
thanks, Pete.
I posted the link. I posted the link in the chat for you guys. It's marketrebellion.com/defend if you want to learn how to build a crash-proof portfolio. Bill, it's all yours.
Okay. Thank you, everyone. Thanks for making it. Now, are we seeing the screen here, Dirk?
Yes, we do.
Okay, all right, good. Yeah, so what I thought would be kind of an interesting twist. Let's talk about some traps that happen when you're hedging in volatile markets. But to first back up, what I talked with Pete a little bit about, you have to understand that markets fluctuate. And I think that's, I mean, it's simple, but it's something you have to really grasp. This is not the first time that we've seen the Dow come, down 2%. Might sound big when it's 700 or 1,000 points, but you shouldn't say that it's unprecedented. They do happen, and that doesn't necessarily mean you have to rush out and buy puts. Just buying the puts by themselves is like, buying insurance when the house is on fire. You can't go out and pay exorbitant premiums and think that it's going to make sense. You always have to say, what is the fair value? How much benefit am I getting? So those are some things this is why you need to be hedged before the events happen. All right. So keep that in mind. But when we're talking about hedging, your hedges should guard against directional risk. Delta is by far and away your biggest risk. Gamma is certainly up there, but if you think about it, gamma is really the acceleration of your deltas. It's still a delta risk. So you've got to guard the directional risk. And what we try to do is to reduce the most for the least cost. And that's probably a real simple way of looking at it. But as I also mentioned with Pete, you have to understand why they work. This is critical. This is why we talk about this in the webinars and with your coaches. You can't just say, oh, last time I bought the VIX and it worked, so therefore might not work if you didn't understand why. That's also important. So when we talk about hedging, you can't go out there and say, let me just go buy puts because the market's turned down and now I'll protect my portfolio. If anything, it's probably going to get you hurt. So what is trap number one? Hedging with the VIX. Everybody loves the VIX because it's the volatility index. So this came out in 1993. Now you'll probably see data that goes back even to the crash of 87 because they can go back and kind of retrofit it to prior dates. But 1993 is when it actually started trading. And it really considers the at-the-money volatility. And that'll be important for just a moment. But it looks at a few strikes out of the money, few strikes in the money. It's trying to figure out the implied volatility for the at-the-money on the S&P 500. So here it is from 1990 through the present. And you can see it just goes sideways. Average is right about 19.5, 20 right now. And you've heard Pete talk about that number. Maybe when it gets above 25, he'll start leaning towards selling. When it gets below there, he'll start leaning towards buying. This is why. It's mean reverting. And you have to be really careful when you're up into these peaks and saying, let me just go buy the VIX. It's virtually a guaranteed losing trade. You have to have these things in beforehand, or at least understand how to use your spreads. Okay, so definitely mean reverting, but when you get big spikes, what do you notice? Comes down just as quickly. So this is why if you do get into it, you can't just hold on to it forever. You have to be right twice. You have to get in at the right time and out. So this is another reason why it's very difficult with the VIX. Now, the volatility index, some other problems, you cannot trade the VIX. Okay, a lot of these futures contracts assume that you can buy the underlying, and therefore it basically is the cost of carry, do what's called a covered interest arbitrage, and they very easy to price the futures. You can't do that with the VIX. And so the futures have risk premiums. Unlike a lot of other futures contracts, I'm talking about the VIX futures. And because of this, it further complicates things. Okay, now you've probably heard of VXX as a short-term ETF of the VIX. All right, this looks at the front month and the near-term contract. Those are your first two contracts. Looking at really the 1 month volatility. All right, well, now you're basically once removed from the VIX, which is already removed from the VIX. And then you have the VXZ, which is a midterm ETF of the VIX that looks at months 4, 5, 6, and 7, tries to keep it weighted around 5 weeks. Now you're twice removed from it. I mean, they become derivatives of derivatives of derivatives. And that's why if you look at them a lot of times on your quotes, they will appear to be missing intrinsic value, but they're not. It's because they're priced on a different futures contract. And if this is making your head spin, this is exactly why you have to be careful about trading them. Okay, now both of these are strongly exposed to what's called contango decay. I talked about the VIX. Usually, a lot of times you have to pay more for the future contracts. And in both of these cases, if you are looking at volatile times, They're selling the cheap one, buying the expensive one that's coming straight out of the ETF equity. And so they just continually bleed away. So if you don't believe it, check out the VXX since 2009. Look at where it started, look at where it is. Virtually bled dry. Now you might say, hey, look at this, it did well through coronavirus, but this is because the markets were in backwardation. They were pricing it on the volatility falling. So when they were rolling these contracts, they were selling the expensive one and buying the cheaper ones, but that only happened for a very brief time. These things are really tricky to use. So if you're not understanding this, at a minimum, be very careful about using the VIX. Like I love Pete's idea. ETF, pick one of the members out of it. You know, if you're using the XLF, use JP Morgan. Do a spread on it. If you've got those shares. Or even just trying to speculate. Not a bad idea, but I'd be really careful about the VIX. Trap number 2, out of the money risk premiums. Okay, we know that out of the money options carry premiums. And usually if you have a smile, the more out of the money, the bigger the premiums. Here's a couple of indexes that a lot of traders don't know about. Condor and Butterfly. Now these you can't pull up on your broker's platform, but if you go to the CBOE's website, they've been trading these since about 1986, I believe. I shouldn't say trading them, but tracking them. And these are looking at condors and butterflies. And so it's a little bit like the VIX, where it's a hypothetical and it's always looking at a 1 month and continually rolls them and reinvest the money, blah, blah, blah. But if you look, here in green is the condor and in black is the butterfly. So the index started back here again about 86 at 100, and now it's up to, hard to see, maybe 600 or 700, 500 maybe. But if you look at that on an annualized growth basis, it's probably 4.5% to 6%. Nothing great. Doesn't mean they're bad, because it is a hedged trade, but you have to be careful about when and how you're using them. Okay, because if you're buying the expensive wings, like after here, crash of 08, this is part of why the condor started to take over. Okay, when the volatility shrinks, your gamma expands, and then what happens? Now the condor becomes more exposed to directional drift and just the path dependency of the stock. And so that's more of the reason why it started to outperform the butterfly. But again, you have to be careful about using. These are measurements more about out of the money options, whereas your VIX is more about at the monies. Okay, so these are some good tools that you can use, but I think it also shows you have to be careful, because if you're buying the expensive wings, that can backfire in a big way. Trap number 3, choosing the wrong strikes. Now you heard Pete talk about spreads. I'm a huge spread trader. AJ, Ryan, Wayne, virtually everybody here will trade spreads at some time, but you got to be careful. So let's take a look at some verticals. These are from a pricing model. I've got 20% volatility and 40% volatility on 2 different spreads. All right, so let's say that we're priced at 20% volatility. This first row shows us the call prices and the deltas, and down here are the vertical spread prices. So up here, if we buy the 95-100 pair, going to cost you $3.32. Okay, if you buy the 100-105 pair, going to cost you $1.70. So if we look down here, we say, okay, I can buy this for $3.32, or I can buy this for $1.70. What do traders do? Let me buy the cheap one. Got to be careful. Notice there's no coincidence here that this $3.32 and $1.70 roughly add up to the difference in strikes. And there's a reason for that. Notice that the deltas are the same. I've talked about this in the cocktail hour. This is why you can't rely just on deltas. So what happens? Let's say that we think that the volatility is going to rise. So here we have the same strikes and the same spreads priced at 40%. It doesn't really matter if it goes to 40, but just some number higher. So if our outlook is that volatility is rising, watch what happens, and this gets interesting. So we think it's going to move from 20 to 40%. Well, look what happened to your spread right here, your 95-100. It goes from 332 to 285. All right, so what is that? 47 cents loss. You've got a huge edge against you. Huge edge against you. Even though you're right that volatility is rising. Look over here. It went from $1.70 to 2. Now you've got a 30-cent edge in your favor. Does that always work? Options were that easy, we wish. In this case, we would prefer the 100, 105. But what if volatility is going the other direction? Now look what happens. If we buy at 285 and it goes to 332, that's good. But if we bought the 100, 105, it goes from 2 to $1.70. Just in reverse. Now we prefer the 95, 100. Why are they switching? You have to understand this. Well, the reason that they're switching is that it's always about control of the at-the-money strike. We know that the at-the-money has the highest vega. So if volatility is rising, a basic rule of thumb is to buy the at-the-money strike, sell the out-of-the-money. If volatility is falling, you want to sell the at-the-money. Now, these are very good rules, assuming we don't have skews. But again, it's just trying to show people why you have to be really careful about saying, I'm just going to go buy puts to hedge, or I'm going to use spreads. You have to understand the details. Now, fortunately, none of this stuff there's a lot to learn, but it's not that complicated. And that's why we'd love to have you join us in the webinars. Speaking of, tonight, 9 p.m. Eastern time, Thursday as well. And Crash Proof Portfolio for those of you who don't want to do it on your own. Fabulous idea, concept. I love the idea. And I think Dirk and Calvin, some others are here to explain more. And I guess, I don't know if we have time, I can stick around for questions as well. So where are they? Okay, well, let me bring up chat while we're waiting for some others to show. I don't know if those are directed towards me. There's Calvin. Well, any questions out there? Any questions on hedging, volatility? Jim, what kind of strike price spread are you using in your spreads? Are you talking about for the example or just in general? In general, I would go with the recipe that I talked about, where if you think that volatility is going to be rising, you should be in control of the at the money. And the reason is that's the one that's more susceptible to vega. But if you think it's going to be falling, then that's when you'd rather be short. Now, of course, both of them will be harmed if volatility is falling. It's just that the at the money is more susceptible. So that's a good recipe, assuming that we are priced flat across the board, which is what the Black-Scholes assumes. Now, in the real world, we might have skews, and we have to be careful of what's called trading in the trough. In those cases, we want to buy the ones at the low implied volatility and be selling the outs. And in those cases, we might always be buying the at the monies. Would you give consideration to buying an out of the money put after a spike in the VIX? I would consider it. I would be very careful about doing it in the VIX for the reasons that I talked about. But an out of the money put, again, the problem is you have to be right twice. You have to get in at the right time, and you have to hope that you sell it. Did you sell it too soon and then watch the market plummet? Or did you, not sell it and watch it end up out of the money? For me, the better way is, as Pete was talking about, have some dry powder on the side so that when you get the pullbacks, not if, when, you can go in there and buy something that doesn't have an expiration date. Because that's really what investing is about. I'd rather see people use that to acquire more long positions. But if you're 100% invested, now you can't do it without going out on margin, and that's going to increase the risk. Heidi, in trap number 3, you're primarily looking at vega, and that's exactly right. Those are vega effects. And again, that's because the at the monies are going to be more susceptible to volatility. And so that's why in the case where volatility was rising from 20 to 40%, we were better off buying the at the money. Okay, both go up, which is actually bad for the short position, but the long position goes up even more. And so that becomes a benefit for us. We get the opposite effect on the way down. So if we think we're going to be in falling volatility, we'd rather, in that case, if we want to be a bull spread, we have to buy the in the money and sell the at the money. Angelo, are there any favorite indicators that Bill uses to determine it's time to be putting on a hedge? You're talking about like technical indicators. I wouldn't say there's not any single one, but I guess you did say indicators. I look at really the basic ones. I primarily look more at candlesticks and major moving averages, which I talk about all the time in the webinars. But I will use RSI, stochastic, CCI, which I know AJ loves the CCI, money flow, market profile. There's a few of them, but I think most of the kit, MACD, try to get a consensus, because remember, none of these are crystal balls. And that's why I think it becomes just redundant to say, let me look at 100 different technical indicators. Just because 3 are in agreement is no guarantee, but it's better than nothing. And so, pick 3 or 4 that you're comfortable with, measure them up against your candlesticks and your moving averages. And I think you'll find that they will definitely give you some very good benefits. Lisa, do you sell out of the money if volatility is rising and buy out of the money if it's falling? Correct. That's, you have to assume that there's no skew premiums. Okay, so I was assuming a flat risk curve in there because we were looking at Black-Scholes option pricing. So your question really gets down to a specific instance. We'd have to look at a specific ticker. But in general, that's the way that I would lean, is that if we think that volatility is going to be rising, you'd really rather be in possession of the at the money, or at least the one that's closer to that, because that's the one that will be most susceptible to that. But again, as a caveat, if the one that's out of the money is jacked up through the roof because of supply and demand, then that might backfire on you. And that's why you'd have to look at it on an individual basis. Gary, what are the parameters in general when you hedge? For example, hedge when VIX up on a position, hedge when ABC happens in the market, and the way to ask, when would you not hedge? For the most part, I do all of my hedges up front. All right, as I talked about in the beginning of the webinar, you have to accept risk. It's a necessary evil. It's the reason that we have returns. Trust me, the one thing that would be absolutely horrible is to have a market that just never ever had any risk. It'd be a life of CDs, treasury bills, 0.1% per year. That's what it would be like in a risk-free world. We don't want that. So don't try to make it that. You have to take some risk, but what you want to do is to define that risk up front. And if you do that before you step into the trade, you don't have to worry about the risk managing you and saying, what do I do now that the house is on fire? Let me go buy insurance at top dollar. That's just not a good way. You have to keep some dry powder on the side, like Pete talked about. I do that an awful lot. Buy on these dips, get 2 candle bounce off of the 100 or 200-day moving average, step in and buy some. If it's not the bottom, no harm done. Do it on the next bounce. And you'll never catch the bottom, or at least probably not, but you'll get really close. And now you've got an asset that never dies. You buy those puts, that's more of like a comfort food. You feel good about buying those puts, but chances are you overpaid for them. And in this game, anything that you overpay for is the kiss of death. You can call it a put, you can call it a protective position, you can call it insurance, a hedge. If you overpay for it, it's no good. And that's what's most likely going to happen if you're doing it in volatile times, unless you're using spreads. Interesting. That's why John and Pete, professional traders, almost always go to spreads in those times. You almost have to. Scott, does being careful with vertical spreads, as you were talking about earlier, have to do with making sure you don't still trade in the trough? Absolutely. Yeah. And I did have a slide on here. We just didn't really quite have the time to talk about it. But yeah, I could probably bring it up. If we bring it back up here. So this is what typically, if we have, let's say, a stock trading at 20%, okay, this is what all of the contracts would trade. So let's say we're looking at August strikes. This is the 35 strike, the 40, and so on. And in the Black-Scholes world, they would all trade at 20%. And that makes sense. It's the same underlying stock for the same length of time. Why would the 40 call trade at a different volatility from the 45 and so on? Black-Scholes says that makes no sense. They should all trade at the same volatility. And that's true until you get into the real world and you find that you get this. Most of the time we get what's called a volatility smile. And that's because we usually get out of the money options for the puts. People pay these premiums, paying more than they theoretically should, but they're cheap and they're going, you know what, it's only 25 cents or 50 cents, I'll pay it. Not saying that's a good idea, but that's what people do. Over here on the call side, what happens? People like them for speculation, buying the out of the money calls, so they're willing to pay more than they're worth. And so yes, if you get this and you get a skew curve and you're buying this one and selling this one, even though you're selling the at the money, that's probably going to be a losing trade. You definitely have a mathematical edge against you for sure. Okay, and that's because you're buying the high implied volatility and selling low. Same thing if you come this way. Okay, what you would want to do is to do this. Maybe buy the at the money and sell an out of the money, or do a spread like this. But as long as you're buying the low implied volatility and selling the high, theoretically you would be much better off. You've got an edge in your favor. But in a case of a skew like this, you're almost always going to have to buy the at the money. Okay, so by the way, this is the at the money that's down here trading at this red line. So yes, that was exactly what I was talking about. You would want to make real sure that you weren't trading in the trough there. Or at least I should say selling in it. What do you do if your account doesn't allow spreads like an IRA? Good question. We've talked about this in the webinars. What do? Synthetics. They allow you to do long stock and a long put. That's a long call. They allow you to sell calls. That's a vertical spread. Not the most efficient way to do it, but you can do it. What if you buy the stock, but buy a higher strike put, which they'll let you do, and sell a lower strike call? You're still selling a call, but now you've got those negative deltas. It becomes a bear spread. So you can always put vertical spreads in an IRA, even if the firm doesn't allow them. You just have to do it synthetically. Yep. Is there a level of VIX below which that we should begin to buy hedges ahead of time, such as VIX below 20 or 15? Theoretically, sure. I mean, if you've said I want to buy 6-month outputs or 1-year outputs because VIX is down at 18 or 15 something, it's better than doing it when the house is on fire, right in the middle of coronavirus. But how many times have we done that and watched the markets just continue to rock away for 2 and 3 and 4 years? And even though you might get kind of a good deal on that first put, you buy it again and buy it again and again and again, and suddenly you have to add up all of that money. And when you look at all of that money, even though maybe that final put does go in the money and you say, yay, I won, well, probably it was still a losing deal. So you have to say that if the VIX is kind of forecasting low volatility, that's kind of a market consensus. I would be very careful about saying, let me buy insurance. But you are right, all things being equal, I would rather see people do it in times like these. Now, this is where the crash-proof portfolio gets really interesting, because they will sell the high implied volatility out of the money calls and buy these puts. But they're doing an effect that's called Trumpification, which many of you might know about from the webinars, where these severely out of the money puts will become 50 delta puts in the event of a crash. Not a little 3 or 5% pullback, but in a real crash. So in a case like that, yeah, that could be a really beneficial part of the strategy. Let's see. Is selling the call spread on the indexes a good form of hedging? I'm actually going to be talking about that in Vegas, about this whole concept of hedging. Selling calls is a hedge, but it's not the best hedge. And the reason I say that is we want to eliminate the major form of the risk, which is what? If you buy the stock and you're selling calls against it, it's that downside. And what does selling a call do? It reduces your upside, negative gamma. It's reducing your upside, but it accelerates the downside. So you are shifting your break-even point a little bit lower. And in that sense, you could say it's a hedge. It's just not a great hedge. So I'd rather see people do that and then maybe buy some further out of the money puts to do more like a collar if you really wanted to create a hedge. Anybody else? Oh, there we go.
I'm quickly going to jump in here. So, Bill, tell folks a little bit about what you normally do on a weekly basis. You've got a number of, educational webinars, right, for our services.
I do, yeah. 8 p.m. on Tuesday, 8 p.m. Eastern, we'd have it for UOA, which is unusual option activity. You heard Pete talk a little bit about it. We got 90,000 contracts coming in on this company. What we might think might be an insider trade, which isn't illegal to trade on for us because that's now publicly available information, but it's a phenomenal service. I love it. But that's only for people in the UOA service. So that's from 8 to 9. And from 9 to 10, so immediately following that, we have beginner to intermediate Q&A. And we talk about topics just like this, hedging, VIX, strategies, trading in the trough. You guys, you control it. You say, here's what we want to talk about. In fact, tonight we're doing a breakout session that is just about how we separate various strategies and try to pick them apart before we actually place them. So fabulous information, all free for most of the services within Market Rebellion. So if you're not familiar with the Tuesday webinars, you should definitely make use of that. And then we do the same thing on Thursday at 9 p.m. 9 p.m. Eastern, which is intermediate to advanced.
Yeah, folks. So just to let you know, so Bill is not only our education guru, but he's helping a number of our members and all our services with education. So I just posted a number, our general number. If you're interested in any education and want to talk to some of our reps about our education deals, we've got some deals where you get some extra free coaching, etc. if you buy a little package. Just to get you started, just call that number 888-982-8342 and ask for, a coaching special, and they can run you through it. You've got a number of coaches who work with, especially Stu, who are working with Bill on a daily basis. Very exciting. So yeah, Bill is regularly there for all our members on the webinars. And if you have any of our education packages, you see him 52 times, actually 104 times a year. With all, if you have a 1-year package, so yeah, that's a lot of education for you guys right there. But again, one more time, I'm going to go back to the offer. It's not even an offer; it's just for you guys to consume. It's the learning about how to build a crash-proof portfolio. Again, just sign up there, and you get access to it. It's normally a course we sell, but literally because we've seen so many questions in the chat rooms in the last couple of days, we felt like, hey, we're going to do this ad hoc on the fly, a webinar for all of you guys. All right. I think that's the end of it, right?
I think so. And I think just to throw in a couple of words for everybody. If you're on the fence about the education, all I can tell you is that you don't know what you don't know. Right. And that's what makes it hard. You say, well, I know how to trade a call and a put. And there is so much to know. And if you're finding out that your trades are either losing or not performing like you think, it's probably a super easy fix. And hopefully the presentation showed you some of the insights why it's not always super easy to just buy a call or a put. But with just a little bit of education, that can make a radical change. So as a commercial used to say, you can either pay me now or pay me later, meaning to Mr. Market. So, get the education and make it a very fun and rewarding journey in your investing career. So we'd love to see you there, and hopefully I see you tonight at 9 p.m.
All right, folks. Thank you so much. Thanks, Bill, for spending the time here.
Thank you.
With all the
Thanks
members. Hey, good luck, guys. It's going to be a rough couple and volatile couple of weeks. Big earnings coming ahead.
Oh yeah.
So yeah, wishing you all the best for the next couple of weeks. Hope this was helpful. Hope you got some insights. Hope the conversation between Bill and Pete was insightful for you guys as well. Thanks again and have a good night.
Thank you. Hope to do it soon.